The best way to build wealth long term is to buy growth stocks that have decades of growth ahead of them and just simply hold them long term. So I have three stocks that I think have a lot of runway for growth, not only in revenue, but also profitability. So these are going to pay off for investors over the course of 10, 20, potentially 30 or more years. My name's Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with a company that isn't necessarily a household name, but that is On Holdings. On is an athletics company. They're known for making running shoes. That's really where they got their start, but they've expanded into things like tennis shoes. Now much more of a casual shoe kind of a company for kind of higher end suburbs, especially in the US, but they have growth all around the world. They're now moving into apparel as well. And when you look at their financials, this is just a compounding machine. These are all trailing 12-month numbers, but you can see that since the end of 2021, the company has grown at a compound annual growth rate of 53%. And I want to stick on how unusual it is for a company that's making a hard good, like a shoe, like a piece of apparel, to be profitable and grow this quickly. That's extremely difficult to do because you're spending money on things like advertising, on building out warehouses, spending more money on operating expenses to grow the business. So you're funneling a ton of money into those operating expenses. Even if your revenue and your gross profit are growing, usually those operating expenses eat up all of your profit. But that's not the case with On Holdings because it is such a profitable company. Gross margins are about 60%, so that's going to be at the high end of what we see in the athletics business or in the apparel business. And it doesn't appear that any of these numbers are slowing down anytime soon. The company has said that they're going to increase their revenue by about 30% on an annualized basis over the next 2 years. That's a guidance that they gave a year ago, and they've basically beaten that guidance over the first year of that 3-year phase. Now, it's easy to also say, this company can grow for a while, but how long is it going to be able to grow for 30% per year? And that's when I go to a chart like this. This shows On's shoe revenue compared to Nike. This is a tiny company compared to the industry behemoth Nike. So On could definitely grow the revenue at 20, 30% or even more for a decade or more and still not get to the size of Nike. Now, shares are not cheap today. On has a $18 billion market cap as I'm recording. The price to earnings multiple on a forward basis is about 52. But remember, this is a high margin company and a high growth company. I think that a reasonable multiple to pay for a quality company like this on any sort of pullbacks, this is the kind of stock I'm going to be adding more of in 2025. The second company is one that I have been holding for a couple of years now, and that is Spotify. Really turned the corner from not just growing its revenue based on adding more and more subscribers all around the world, but now it's growing its profitability, gotten operating margins in line, and then it's been able to lean into things like price increases. And now the next step for Spotify is growing in other areas of the business that it hasn't traditionally grown, like advertising and in video. But let's go to those high-level metrics because I think this really shows how quickly Spotify has turned around its cash flow. You can see that this has been a company that's been growing consistently for years, but it hasn't been growing profitably. That changed in 2023 when you see there's a sharp increase in their free cash flow. That's because of that containment in operating expenses. They also increased their prices, so they're now actually generating better margins on their traditional premium business than they previously have. The advertising business should continue to improve. Their podcast exclusives that they were spending tens of millions of dollars on per year, that was included in the advertising business. So we'll see some of that come off over the next few years. And I think advertising has an opportunity to grow as they build out their ad network and move into new areas like video, maybe seeing more of those video podcasts. That's something that I think Spotify could really grow into. Maybe isn't going to be a competitor to YouTube, but this could be a growth avenue for Spotify going forward. And the reason this is a company to hold long-term is because I don't think anything is going to change about the digital distribution and the hold that they have on customers, especially in the music business. Spotify has become the go-to platform for not only music, but also for podcasts. And if they are able to expand that into things like video, audiobooks, and even courses, something they're experimenting with as well, these are going to be areas of growth that could compound the business for years and years to come. We're talking about one of the very few businesses that could have 1 billion users or more just a few years from now. And I don't see any disruption coming to Spotify from something like artificial intelligence or any of the new tools that are making their way to the market. This is going to be a valuable distribution medium for the foreseeable future. Love where Spotify is sitting today. It's, again, like On Holdings, got much more expensive over the past few years, but still a buy and hold stock that is growing consistently year after year. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The third company is one that owns the platform that you are watching this on today. That is Alphabet. Alphabet owns everything from search to YouTube, Google Cloud, Waymo, lots of businesses under Alphabet. And the great thing is they are all growing. They are all at scale. And I think a lot of them have more impenetrable moats than a lot of investors think. Let's just go through a few of these segments. The first is Google Search and Other, and then also their Google Network revenue. These kind of tie together. It's the advertising network that Google's business is really built on. It was impacted by Apple's ATT a couple of years ago, but you can see that these businesses as a combined force are now back to growth, back to double-digit growth levels. And I think that's going to continue as people are using search more, and as search and the advertising business that's behind it starts to power things like artificial intelligence. The other thing that's growing is YouTube. This is just the advertising revenue for YouTube, but Alphabet CEO Sundar Pichai said recently that the entire YouTube business is now generating $50 billion per year in revenue. That includes the premium side of the business. There's also subscriptions, platforms, and devices revenue. This is things like G Suite, Android, and the Play Store, the smartphones that Google is selling. This is going to be the distribution mechanism for a lot of the AI tools that we see being built today under the Alphabet umbrella. So this is a business that's growing today, but I think in the future, this is going to be a much, much larger business because this is a company that's vertically integrated in AI. They're building their own models. They have their own cloud infrastructure. They have their own devices, both that they make, and then also when other companies are building on their platform, the Android platform. That's going to be a phenomenal distribution medium for them. Going to be a little bit different business model than Apple was, but I think could be even more valuable than Apple just in this distribution and hardware devices. The final thing that's growing, and this has potentially decades of growth ahead, that is the Google Cloud. Google Cloud is growing about 30% annually right now. It is also now profitable, generating about a 10% operating margin. That operating margin should increase to more like 20 or 30% over the next 2 years to match some of its cloud rivals. And this is a business where once you get to scale and you're one of the 3 or 4 biggest cloud companies in the world, how is anybody else going to compete? I think that's a sustainable advantage that's gonna exist for many, many years. Arguably, Google has the best infrastructure with all the infrastructure and the microseconds that it's taken out of the time to complete a search. That's gonna make things like its AI tools built on the cloud much more valuable for developers in the future. So I see a really bright future for Google Cloud as well. On top of this, not even in the numbers that we know today, Waymo is a business that could disrupt transportation. That could potentially be a $1 trillion business, being that's the only company that's currently on the road today with a fully autonomous vehicle moving into a scale that's actually starting to scale. And there are also other bets inside the business that could grow, things like quantum computing as well. So I think Alphabet is another stock very well positioned. And unlike the other two, arguably a value stock. Today, trading for a little less than 23 times forward earnings. And I think those earnings are going to continue to grow not only based on revenue growth, but also margin expansion as businesses like YouTube start to get more profitable in the future. So those are the 3 stocks that I think are a great buy today and hold for the very long term: On Holding, Spotify, and Alphabet. Let me know what you think of those 3. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.